Okay, station 2, shareholder.
Hello, Hi, Mr. Buffett. My name is Bernhard Führer from Austria, Vienna. My question is about banks. What's your view on the European banks? What's your view on the US banks? And what must happen that you invest in European banks? Thank you.
Well, I have a decidedly different view on European banks and American banks. The American banks are in a far, far, far better position than they were 3 or 4 years ago. They've taken most of the abnormal losses that existed or that were going to manifest themselves in their portfolios from what's now 3.5 or 4 years ago. They've buttressed their capital in a very big way. They've got liquidity coming out their ears at the bigger banks. The American banking system is in fine shape. The European banking system was gasping for air a few months back, which is why Mr. Draghi opened up his wallet at the ECB and came up with roughly €1 trillion of liquidity for those banks. Now, €1 trillion is about $1.3 trillion, and $1.3 trillion is about 1/6 of all the bank deposits in the United States. I mean, it was a huge act by the European Central Bank, and it was designed to replace funding that was running off from European banks. European banks had more wholesale funding than American banks on average. If you look at the Bank of America or Wells Fargo, they get an enormous amount of money from a natural customer base. European banks have tended to get much more of it on a wholesale basis, and that money can run pretty fast. So the European banks need more capital in many cases. They've done very little along that line. One Italian bank had a rights offering here 3 or 4 months ago. But basically, they have not wanted to raise capital, probably because they didn't like the prices at which they would have had to do so. And they were losing their funding base. The problem on the funding base has been solved by the ECB because the ECB gave them this money for 3 years at 1%. I'd like to have a lot of money at 3 years at 1%, but I'm not in trouble, so I can't get it. But if you look at our banking system, it's really remarkable what's been accomplished. I thought at the time that the Treasury and the Fed were maybe a little overdoing it when they brought those bankers to Washington and banged their heads together and said, you're going to take this money whether you like it or not. But overall, I think that policy was very sound for this country's economy. And if some banks were forced to raise capital that they didn't need, which I might not have liked as a shareholder of one of them, overall, I think that our society benefited enormously. And I think the Fed and the Treasury has handled things quite sensibly during a period when if they hadn't handled this sensibly, that our world today would be a lot different. Charlie?
Yeah, Europe has a lot of problems. We don't. We've got this full federal union, and the country that runs the central bank can print its own money and pay off its own debt and so on. And in Europe, they don't have a full federal union, and that makes it very, very difficult to handle these stresses. So we're more comfortable with the risk profile in the United States.
It's night and day. I mean, in the fall of 2008, when essentially Bernanke and Paulson and implicitly the President of the United States said, we'll do whatever it takes, you knew that they had the power and the will to do whatever it took. But when you get 17 countries that have surrendered their sovereignty as far as their currency is concerned. You know, you have this problem. Henry Kissinger said it a long time ago. He said, if I want to call Europe, what number do I dial? You know, and when you have 17 countries, and just imagine if we'd had 17 states in 2008, and we had to have the governors of those states all go to Washington and agree on a course of action when money market funds there was a panic in there, the panic in commercial paper, you name it, we would have had a different outcome. So I would put European banks and American banks in two very different categories. Okay, Andrew.
Okay, you'll know why I'm asking this question in a second, and why I picked it. This question is the following. Is Berkshire too big to fail? On the same topic...
I think I heard of a book by that name. Who wrote it?
On the same topic, how do you feel about Dodd-Frank, and now that it's being implemented, how is it impacting Berkshire's insurance businesses and our investments in banks like Wells Fargo and Goldman Sachs?
Yeah, I don't think it's affecting Berkshire's insurance businesses, to my knowledge. I mean, we've had, to my knowledge, we've never had anything that impinges on our activity arising from a too big to fail doctrine. The capital ratios for large banks are being established at somewhat higher levels than smaller banks, and that obviously affects return on equity. The ratios, as I understand it, for Wells are not as high as they would be for Citi or JP Morgan, but they're higher than they would be for a local bank in Omaha. And the higher the capital ratio, the lower the return on equity will be. I consider the banking system in the United States to be stronger than certainly any time in the last 25 years. Capital is dramatically higher. A very significant part of the loans that were troublesome are gone. The loans that have been put on in the last 4 or 5 years are far better. I think we've got, Canadian banking system is very strong, but compared to Europe, I think our banks are, or compared to our banks of 20 years ago, I think they're dramatically stronger than they were then. I do not worry about the banking system being the cause of the next bubble. I mean, it will be something else. I mean, we will have bubbles in capitalism. Capitalism goes to excess, and it's because of the humans that operate in it. And we will have that again, but usually you don't get it the same way as you got it before. I don't think it'll be a housing boom next time. But I feel very good about our investment in Wells Fargo. I feel very good about our investment in U.S. Bank. I feel very good about our investment in M&T. All of those are very strong banks pursuing, in my view, sound practices, and they should be decent investments over time. They won't earn as high a return on tangible equity, nearly as high a return as they would have 7 or 8 years ago, because the rules have been changed, and they have been changed to provide thicker equities, and that pulls down return on equity. Charlie has been known to express himself on this subject, and I'll give him the floor.
Well, I'm a little less optimistic about the banking system long term than you are. I would like to see something more extreme in terms of limiting bank activities. I do not see why massive derivative books should be mixed up with insured deposits that are insured by the country.
I'm with Charlie on that.
The more bankers want to be like investment bankers instead of bankers, the worse I like it. I don't want to say more.
Yeah.
I get in enough trouble on the subject already.
Yeah. I can see the journalists just licking their chops over there, waiting for Charlie to throw a thunderbolt, but he's unusually restrained. We're now very close to noon. Okay, station 6.
Hi, my name is Michael Mazia. I'm from Brooklyn, New York, and I'll be starting at Wharton Business School in the fall. In an interview with Bloomberg Markets recently, Jamie Dimon defended the role banks play in financial markets, saying banks aren't markets. The market is amoral. You're a trade to the market. A bank is a relationship. But banks, namely investment banks, have struggled as regulators have favored market-based solutions, and many of those relationships investment banks have worked so hard for have proven to be less lucrative, especially compared to the growing fixed costs of supporting them. As it relates to our marketable securities portfolio, how do you feel about the investment banking component, particularly as Wells moves into that space? Would you feel differently if the cost basis was higher? And Warren, Charlie, thank you so much for doing this every year.
Thank you. Charlie, I didn't totally get that, but does he feel the investment banking firms are being disadvantaged?
Well, he's basically, how do we feel about, Jamie says that you can't make as much money as you used to out of relationships, and it's getting tougher and so forth.
Yeah. Well, the public policy since 2008 and 9 has been to very much toughen up capital requirements in a variety of ways for banks, but it is specifically been designed to make large banks, very large banks, less profitable relative to smaller banks. And you do that by increasing capital requirements. So you can change the math of banking and the attractiveness of banking totally by capital requirements. Obviously, if you said every bank had to be 100% equity, it would be a terrible business. You couldn't possibly earn any money that was significant on capital. And if you let people operate with 1% capital ratios, they can make a lot of money and they will cause the system all kinds of trouble. So since 2009, the rules have been tilted against the larger banks primarily through capital requirements. And that just means returns on equity go down, but returns on equity were awfully high prior to that. So it hasn't turned it into a bad business. It's turned it into a less attractive business than earlier. And that some of the investment banks operate as bank holding companies still, and they've been affected by those capital requirements too. I'm not sure getting 100% to your question, so I invite you to give me a follow-up if you'd like on that.
In the marketable securities portfolio, do you feel good about the going forward prospects of the investment banking companies, especially as Wells Fargo moves into that business?
Well, Wells Fargo has an investment banking aspect to it that primarily came in through Wachovia, and it's not insignificant, but our ownership of Wells Fargo, which is very large, it's our largest single marketable security. I'm not counting Kraft Heinz, which is about the same size, because in that situation we're in a control position. It's the largest non-control situation that we have at Wells Fargo, and that's by intent. I like it extremely well compared to other securities, not because it has the most upside, but I feel that weighted for upside and downside that it's.
But it's not the investment banking that charms you in Wells Fargo. It's the general banking that.
Yeah, no, it isn't that big a deal, and that's not what attracts us. We think Wells Fargo is a very well-run bank, but we didn't make any decision to buy a single share based on the fact they were going to be more in the investment banking business because of the Wachovia acquisition. They've got a lot of sources of income. They've got a huge base of very cheap money, but unfortunately, they've got it out at very cheap rates on the other side now. But spreads will probably work in their advantage eventually. And we think it's a very well-run bank. Investment banking business, Charlie and I are probably a little affected by the experience we had in running one for a short period of time. It's not been something we invested in significantly. We obviously made a major investment in Goldman Sachs, and we continue to hold shares that came out of the warrants that we received when we made the investment in 2008. But I can't recall us making a investment banking purchase, a marketable security involving an investment bank for a long time. Can you, Charlie?
No, I think generally we fear the genre more than we love it.
Becky?
This question comes from Brian Gust of Grafton, Wisconsin. He's talking about regulators and politicians and says the Berkshire Hathaway investment portfolio holds several large financial institutions that are heavily regulated and are politically charged. Do you feel that in some cases the regulators and/or politicians are running the big banks instead of the CEO and the board of directors?
Sure. But not too much.
No, insurance has been regulated. It happens to be regulated primarily on a state basis, but insurance has been regulated ever since we went into it. And it hasn't, when I looked at GEICO, it was doing $7 million of business, and it will do 30-odd billion of business now. It's been regulated the whole time, and regulation can be a pain in the neck generally. But on the other hand, we don't want a bunch of charlatans operating in the insurance business, and insurance actually lends itself to charlatans because you get handed money and you give the other guy a promise. And I like the fact that there is regulation in the insurance business or the banking business. It doesn't mean it can't drive you crazy sometimes or anything of the sort, but those businesses should be regulated. They're too important, and any time you can take other people's money and they go home with a promise and you go home with the money, I don't mind a certain amount of regulation in those businesses. Charlie?
Yeah, well, if you're using the government's credit because you have deposit insurance, there's an implicit bargain. You can't be too crazy with what you do with the money. That's a perfectly reasonable. And I absolutely believe that we should have a regulation system that involves supervision of risk-taking by banks. It got particularly bad in the investment banks at the peak of the real estate crisis. And the behavior was, there's only one word for the behavior. It was disgusting. And it was pretty much everybody. It's hard to think of anybody who stayed sane in that boom. They felt the other guy's doing dumb things, I've got to do it too, or I'll be left out. What a crazy way to behave. And so, sure, there's some intervention, but probably has to be.
You want a Food and Drug Administration. Yeah. You'll be unhappy with how they do it if you're in the business and all of that, but I find any kind of regulation irritating, but nevertheless, it's good for the system. And actually, a number of regulators, I would say that they've really been quite sensible about regulation. But, you don't feel that way when you're being told how to run your business. But as Charlie says, you wouldn't want to be a bank that ran in an unregulated system where anybody could come in and do all kinds of things that would actually have consequences that drew you into the problems that they created themselves. We had the Wild West in banking long ago, and it produced a lot of problems in in the 19th century.
This is one that comes from Thomas Lin in Taiwan. He says, Warren once said that banking is a good business if you don't do dumb things on the asset side. Given that the pandemic might put a lot of pressure on the loans, dumb things that got done in the past few years are likely to explode. Through reading annual reports, 10-Qs, and other public information, what clues are you looking for to decide whether a bank is run by a true banker who avoids doing dumb things?
That's a very good question, but I would say that the one thing that made Chairman Powell's job a little easier this time than it was in 2008-9 is that the banks are in far better shape. So in terms of thinking about what was good for the economy, he wasn't at the same time worrying about what he was going to do with Bank A or Bank B to merge them with somebody else or added strains on the system or anything. I mean, the banks were very involved with the problem in 2008 and 9. They had done some things they shouldn't have done in some of them, and they were certainly in far different financial condition now. So that the banking system is not the problem in this particular show. I mean, the government we decided as a people to shut down part of the economy in a big way, and it was not the fault of anyone that it happened. Things do happen in this world. Earthquakes happen. Huge hurricanes happen. This was something different, but the banks need regulation. I mean, they benefit from the FDIC, but part of having the government standing behind your deposits is to behave well, and I think that the banks have behaved very well, and I think they're in very good shape. I mean, that's why the FDIC has built up $100 billion that I've talked about. I mean, they've assessed the banks in recent years at accelerated amounts in certain periods, and they even differentiated against the big banks. So they built up great reserves there, and they built their own balance sheets, and they are not presently part of Chairman Powell's problem, whereas they were very much part of Chairman Bernanke's problem back in 2008 and 9. How you spot the people that are doing the dumb things is not easy because, well, sometimes it's easy, but I don't see a lot that bothers me. But banks are, in the end, institutions that operate with significant amounts of other people's money, and if problems become severe enough in an economy, even strong banks can be under a lot of stress, and we'll be very glad we've got the Federal Reserve System standing behind them. I don't see special problems in the banking industry now. I could think of possibilities, and Jamie Dimon referred to this a little bit in the J.P. Morgan report. You can dream of scenarios that puts a lot of strain on banks, and they're not totally impossible, and that's why we have a Fed. And I think overall the banking system is not going to be the problem. But I wouldn't say that with 100% certainty, because there are certain possibilities that exist in this world where banks could have problems. They're going to have problems with energy loans. They're going to have problems. They're going to have extra problems with consumer credit. They're going to have, they're in, but they know it, and they're well reserved. Well, they're well capitalized for it. They were reserve building in the first quarter, and they may need to build more reserves, but they are not a primary worry of mine at all. We own a lot of banks, or we own a lot of bank stocks. Greg, do you have any thoughts on it?
No, I really, you touched on it earlier too, just in general, which is we don't know how long this pandemic will go. We don't know if there's going to be a second event, which are just risks that are really unknown at this time, and the banks will have to continue to manage through that as the businesses do. But you've already highlighted that, obviously.
This question circles back to banking, which you touched on earlier, but Jerome Bernard from Switzerland writes, could you please explain why you decided to exit most of your bank stocks in 2020, except for Bank of America, and what's your view on the future of the banking industry?
I like banks generally. I just didn't like the proportion we had in it compared to the possible risk if we got bad results that did not, so far we haven't gotten. So we were over 10% of Bank of America. It's a real pain in the neck, both to the bank and more to the banks than to us if we go over 10%. There's just a whole lot. And I like the Bank of America. I mean, I like Brian Moynihan very much. And I like the banking business fine. So we took that up, but we took the overall bank position down. We didn't want to go above 10 in any of the others, and we did want to increase the B of A position, but we overall didn't want as much in banks as we had. We like the banking business is way better than it was in the United States 10 or 15 years ago. The banking business around the world, in various places, might worry me, but our banks are in far, far better shape than 10 or 15 years ago. But when things froze for a short period of time, the biggest thing the banks had going for them is that the Federal Reserve was behind them. And the Federal Reserve they're not behind Berkshire. It's up to us to take care of ourselves.